The portfolio in 2020 and in the past quarter performed as we would have anticipated. In the first part of last year, it protected on the downside, as often is the case with our approach, and we were able to take advantage of many of the opportunities that we saw during the drawdown, which helped us participate quite well in the subsequent rebound in the overall markets. Later on in the year, as some more cyclical businesses and some lower quality companies started to outperform in anticipation of a strong economic rebound, the portfolio lagged a little bit relative to its benchmark, but participated strongly on an absolute basis. And net, the portfolio generated significant excess returns with a lower level of variability relative to its peers during what was a pretty difficult period in the marketplace. The volatility over the course of 2020 and some of the rotations that we saw over the course of the year impacted the portfolio in a couple of different ways. First, during the drawdown early in the year, the portfolio was able to protect capital on the downside because the fundamentals of the businesses that we gravitate to hold up better than the average company. In the subsequent strong rebound, we were able to take advantage of the prior weakness to add companies to the portfolio that we felt would be strong beneficiaries of a rebound, and we benefited from those actions in the second half of the year. Later in 2020, particularly during the fourth quarter, as some of the more cyclical, lower quality companies in the marketplace tended to dominate some of the market returns, the portfolio lagged a little bit on a relative basis, but yet participated very strongly on an absolute basis. And over the course of the first quarter of 2021, we have seen that continue. Overall, we feel very strongly both in the way the portfolio is positioned today and the portfolio performance was very much in line with what the historical pattern has been in periods of volatility. The advantage that we have at SGA is, as they say out west in the US, this wasn't our first rodeo. We've experienced crises before, most significantly in 2008 and 2009, and the team that is in place today is the same team that was in place during that period of time, and the stability in our organization allows us to be able to react to events with the same people that have experienced prior crises. In this particular instance, what we did very early on in February is we started modeling for all of our companies a 3-month economic shutdown on a global basis, and we reflected that in our earnings and cash flow estimates for the businesses. What that led us to do was to be able to have a clear view of how the companies were likely going to be impacted. And as a result of that, we were armed with the conviction to take advantage of the opportunities when they presented themselves, and there were plenty of opportunities in the early part of 2020. There were a number of surprises in the market last year, but what was perhaps the biggest was the speed at which the downside occurred in the February and March period, and the speed at which the subsequent upside took place in the month of April and beyond. And the main driver for the quick turnaround that we saw in the second half of the year was really driven by the growing optimism that this crisis would not have the long-lasting effects that were feared in the earlier part of the year. And the optimism was driven by, one, the prospects that vaccines were going to come perhaps sooner than historically vaccines have been developed. Two, that the global monetary and fiscal stimulus that were being passed around the world would put a significant floor on the economic impact of the pandemic. Three, that as we moved closer to the second half, particularly in the United States, that the potential of a presidential election might reduce the significant amount of negative rhetoric that the country had experienced before. And four, very importantly, that a recovery would unleash significant pent-up demand as a result of the strong savings rates that were taking place around the world as consumers hadn't been able to go out and spend. As a result of that, the speed at which the recovery took place validated a number of the decisions that we made early in the year to take advantage of opportunities. And frankly, we were pleasantly surprised that we were able to gain some nice returns for clients earlier than we had anticipated. The vaccination drive that is now taking place on a global basis is certainly a positive development and has been an earlier than expected development, certainly last year. What we have continued to do is apply the process the way that we always have, recognizing that what vaccinations are going to do is open up economies perhaps faster than was expected as recently as 6 or 7 months ago. In the very near term, what is likely to take place is that some of the companies that were perhaps penalized much more than others earlier in the crisis will be more direct beneficiaries of the rebound. But over time, what that will continue to do is emphasize those businesses that have strong secular drivers behind their growth, have a significant amount of predictability in the growth rates, and have the ability to continue to deliver not just over the short term because of a cyclical rebound, but over a multi-year period. We have not made any specific changes to the portfolio as a result of the increase in bond yields. And we are of the view that while inflation will rise in the short term, particularly reported inflation, the core inflation figures will remain tame as a result of a number of secular aspects like productivity, like the fact that there is still a significant amount of slack in the labor market, and we do not view inflation as a real risk to equity valuations over the course of the next 12 to 24 months. Inflationary pressures are the potential biggest risk for long duration assets. We have factored in higher discount rates in our valuation methodology to factor in the potential that inflation could come up, certainly in the short term over the course of 2021. One of the aspects of our process is to look for businesses that have a high degree of predictability and sustainability, and one of the characteristics that we focus on is a high degree of pricing power. Pricing power is perhaps the single best offset in an inflationary environment because it allows the companies to price products and to reflect price increases on the raw material side and pass that on to its customers. We take great comfort in the fact that the companies within the portfolio all have a significant amount of pricing power and should be able to navigate an inflationary environment far more successfully than companies that do not. We do believe that valuations today are less attractive than they were as recently as a couple of years ago, and certainly less attractive than they were 10 years ago. On an absolute basis, the portfolio today is trading at higher multiples than it was at those prior times, as obviously is the overall market. Having said that, what is very comforting to us as we look at valuations is that today this portfolio of very high quality businesses with significantly higher structural profitability, higher growth rates, lower level of variability in the fundamentals of the underlying companies that make up the portfolio, is trading at about the same multiple on a cash flow basis as the broader market. So as we look out over the next 3 to 5 years, which is our typical investment horizon, we feel very strongly that the potential for returns that are greater than the market during this period of time is quite robust. While the overall returns may be more muted over the course of this period, as the returns have been over the course of the last 3 to 5 years, we do believe that they should be in line with the underlying earnings and cash flow growth of the portfolio companies, which are expected to be in the mid-teens range, 13, 14, 15%. Two companies in particular provided strong returns over the course of the last year and continued in the past quarter. The first is HDFC Bank, which is the fourth largest bank in India, which has continued to be a beneficiary of the significant growth in the middle class and the fact that they bring in modern retail banking practices to a market, the market of India, which has historically been significantly underserved by its financial institutions. Over the course of the economic downturn that took place as a result of the pandemic last year, there were some real concerns that HDFC as a bank would see a significant degradation in its credit quality, would have to start taking a significant amount of write-offs. That did not take place. And the asset quality of HDFC has returned very quickly to normal. Its growth rate has started to recover. And as a result, the company actually has rebounded quite strongly and the portfolio has benefited from that rebound. The second company is Autodesk. Autodesk is the global leader in computer-aided design and manufacturing. It's a software company that has been very successful in migrating its business model away from licenses that operate on desktop to a software as a service model, which is a licensing model. And while there was, over the course of the shutdown, a temporary slowdown in demand, what is quite encouraging and has propelled the stock higher was that as economies started to reopen and as people adjusted to working from home as opposed to working in the office, they continued to use the CAD/CAM, the computer-aided design and manufacturing platform that Autodesk is so strong in, simply in a different environment. And so very quickly you saw the company's growth return to pre-COVID level in a number of different markets. Alibaba was a stock that was disappointing over the course of 2020. Ironically enough, that had nothing to do with its performance during the pandemic from a fundamental standpoint, and had a lot more to do with the central government imposing some sanctions because they were not pleased with the rapid growth in Alibaba, particularly in financial payments, and wanted to remind the company who ultimately was in control in China. Alibaba is the leading e-commerce platform in China and Southeast Asia. It's a very important element of the Chinese government's goal to migrate its economy to a service, consumer-led economy away from a manufacturing economy. And as a result of that, we continue to maintain conviction that Alibaba is going to be a company which will provide strong returns over the past couple of years, and that the disappointment in the fourth quarter of 2020 is likely going to be short-lived. ESG has always been a very important component of both our research process, our portfolio management process, and the underlying analysis that takes place when we allocate client capital. After all, sustainable is our first name. And we've always looked for companies that had sustainable, predictable growth in earnings and cash flow. And the only way to do that over the long term is that if you're a good steward of environmental, social, and governance policies. ESG is a critical element of our analysis. We engage directly with the companies to make sure that we are fully aware of both the opportunities but also the risks of ESGs as it relates to every single company under our coverage, and that the management teams are fully aware and addressing our concerns as it relates to ESG. We do not believe that we have to sacrifice returns through the careful integration of ESG principles within the investment process. In fact, we think that the reverse is more likely. Companies that do not focus on ESG and managers that do not focus on ESG run the risk of seeing a degradation in returns as ESG risks impair a company's ability to be sustainable and predictable over the long term. What we do is fully integrate ESG principles within our process and look for companies that are going to be beneficiaries of the integration of ESG in terms of the quality of their operations and the predictable nature of their earnings and cash flows. And we anchor our conviction on those principles. One of the companies that we have had significant amount of engagement with is Linde. Linde is the global leader in manufacturing industrial gases that are used in the manufacturing process for many products by many companies around the world. The biggest issue when it comes to Linde is the carbon footprint that its products leave, and very importantly, the carbon footprint that its products will leave as part of manufacturing processes of its customers. And while the company has some aggressive targets in reducing its carbon footprint by 2030, mainly about 35% in reduction in carbon footprint, we simply don't think that those targets are aggressive enough. And we've been engaging actively with the company to try to get them to lower the targets even further.